This is Asia Trade. I'm Shery Ahn in Tokyo.
And I'm Avril Hong at the Singapore Milken Institute Asia Summit. Here are your top stories this hour. Asian stocks set for a weaker open after a tepid session closes out Wall Street's best September in 15 years. A looming U.S. government shutdown hanging over markets. President Trump threatening to cut federal workers and programs favored by Democrats if there's no deal by the midnight deadline. And we have a great lineup of exclusive guests from here at the Milken Institute Asia Summit, starting with Capital Group's Noriko Chen. But first, Shery, it's really this focus on the looming U.S. government shutdown.
We take you straight to Congress because we're now seeing the Senate voting on that bill to avoid that government shutdown. Right now, they lack the votes to pass the Senate. And remember, this would be the first government shutdown if it happens in the next few hours since 2018. That was during President Trump's first term. And remember, that was also a record long one of 5 weeks. And right, Avril, we know that these 11th hour agreements do happen. But right now, it seems that Democrats and Republicans are no closer to a deal, especially when it comes to Democrats wanting that extension of health care subsidies, reversal of Medicaid funding cuts as well, and other demands. This is what Senate Democratic leader Chuck Schumer had to say about being bullied to pass this bill, which, of course, the vote is ongoing right now at the Senate. Take a listen.
They don't give a damn about the harm they will cause with their shutdown. Now, Republicans have until midnight to cut the garbage and get serious with us about solving the health care crisis.
And Shery, what's also interesting is how either side has been playing this blame game. And now we're actually hearing from some of these U.S. agencies. They are assigning blames to the Democrats for this government shutdown. We're hearing from the U.S. Department of Housing, and they're blaming the Democrats. Not only is this an unusually public comment and quite partisan, it could also be in violation of federal law. Aside from this, we also heard from the Senate Majority Leader John Thune weighing this out. Have a listen.
We are only hours away from a government shutdown, and the Democrats have a very clear binary choice. They can choose to keep the government open by voting for a short-term, nonpartisan, clean continuing resolution, 24 pages long, or they can vote to shut the government down.
For more, let's bring in Bloomberg Congress reporter Alicia Diaz, who is in Capitol Hill for us. So, Alicia, talk us through what the impasse is about here. What can't the two sides agree on?
Yes, Capitol Hill. Right now, as you said, it looks like a U.S. government shutdown is inevitable. The vote is ongoing. However, they don't have enough votes to pass the Senate. And so we're seeing all signs that that shutdown is going to happen at midnight, barring some kind of a last-minute final hour negotiation. And it remains to be seen. I mean, Republicans have really been saying that they don't see a future for extending the Obamacare subsidies that Democrats really want to include in this bill, while Democrats say this is their one chance, being the party that's not in power, to really get a say and show that their constituents that they're doing something. So they're putting a lot of, political currency on this moment. And it could backfire. It could work in their favor. It remains to be seen. Regardless, of course, there is a lot at stake here. Uncertainty in the financial markets is definitely one of those factors.
What does this mean for President Trump? Because he's now saying that a lot of good could actually come from a government shutdown. And we know that the last one happened under his watch, and it lasted 5 weeks.
Exactly. And so, again, Democrats are really pointing to the idea that voters will see President Trump in power. They know that Republicans have the Senate and they have the House. They're banking on the idea that voters will see this happening and think, okay, Republicans are the one who are shutting down the government. On the other hand, Republicans argue that it's the exact opposite, and they're really trying to message that it's the other party's fault. And so it is kind of this back and forth of, political jabbing at each other. And at the same time, there are these great policy risks. There are jobs at stake here. And so in the next coming days, weeks even, we'll see how this plays out.
How long might this last if we actually do see a shutdown?
That is the question that we're all wondering. Of course, you said that the 2018-2019 shutdown was record-breaking. It was, I think, roughly 35 days, and that was under President Trump's first administration. Right now, Democrats are really saying, we're not going to cave for a 7-day clean way to extend the government spending. They're really banking on these Obamacare subsidies being extended, and they're saying if we don't get this, we will do whatever it takes. Of course, there has to be a negotiation at some point. There will be some sort of compromise, but neither side is caving right now.
Bloomberg's Alicia Diaz there with the latest on the ongoing vote in the Senate, as you can see, when it comes to that bill in order to avoid a government shutdown. And really, when it comes to government shutdowns in the U.S., very typical to see 11th hour agreements. At the moment, we don't have one. And really, the impact on the markets could depend on how long a government shutdown lasts for. Take a look at how the S&P 500 finished. Slight gains in the overnight session, and this leading to second consecutive quarter of gains for the S&P 500, best September in 15 years, but small gains and losses throughout the session given this looming shutdown and the expectation that perhaps it could have macroeconomic implications. And that's the biggest thing when it comes to this government shutdown. Will we see federal jobs lost? And if that happens, will we see jobless claims, for example, rising? And the fact that the Friday payrolls numbers are also at risk at this point. And what does that mean for cyclical stocks is also a key question. We saw treasuries gaining ground. We continue to see that safe haven demand that could lead to more rallies as we're seeing this bullish positioning in the treasury space, the dollar under pressure, which is usually what happens during a government shutdown. Take a look at gold, because we had already soared to record highs around that $4,000 level. And we had seen this rally waver a little bit given the uncertainty of this upcoming shutdown. But historically, what happens during a government shutdown, Avril, and we have many examples of this happening in the U.S. government, is that gold continues to gain ground over that safe haven appeal.
Shery, here are some of the stories we're following out of the U.S. President Trump has told top military brass that the U.S. is fighting what he calls an invasion from within. And at a rare gathering of officers stationed around the world, Trump delivered a largely political speech emphasizing border security and the need to root out so-called woke culture. He also declared his unwavering support for the troops.
My message to you is very simple. I am with you, I support you, and as president, I have your backs 100%. You'll never see me even waver a little bit. It's the way it is. And that includes our great police officers and firemen and all of these people that are doing so well.
President Trump also says his administration is close to finalizing a deal with Harvard University. An agreement would potentially diffuse one of the highest profile fights between his administration and U.S. higher education. Trump initially accused Harvard of failing to tackle anti-Semitism on campus, but later broadened that to include allegations of political bias.
We're in the process of getting very close, and Linda's finishing up the final details, and they'd be paying about $500 million, and they'll be operating trade schools. They're going to be teaching people how to do AI and lots of other things, engines, lots of things. We need people in trade schools.
And this is a setup across Asia. We saw Japanese stocks falling for the last 3 sessions. Futures pointing to a little bit of upside of 0.1%. This, as we've been watching the JGB space with that 2-year JGB auction drawing the weakest demand ratio since 2009. And we now have the Bank of Japan scaling back purchases of super long bonds, and that statement coming out overnight as well. Third quarter Tankan survey numbers out this hour. Do watch out for that. Do watch out for the Aussie as well, which gained ground against the U.S. dollar with the RBA leaving the cash rate unchanged. And a little bit perhaps of light trading today, given that China and Hong Kong are away on holidays. But we've just learned that the yuan is moving closer to replacing the pound as the fourth most traded currency. Global trading of the yuan surging to $817 billion a day. The yen's share of that market is still steady. More ahead on the Asia trade. This is Bloomberg. The 10-year yield in Treasury is holding at that 4.15 level or so. And this, of course, as we have continued to see those gains in Treasuries for a third consecutive quarter already. And given that we are headed to a potential U.S. government shutdown, bullish positioning also continuing to rise. Really, traders weighing the potential of that shutdown, weighing on the economy and what the Fed might do. Could we see those cuts coming? Bond traders pumping millions of dollars in options wagers. The 10-year Treasuries are on the cusp of a rally. Let's bring in Diron, Managing Director of Global Sovereign Risk at Moody's Ratings, today in Tokyo, usually in London. So thank you very much for coming in.
Thank you for having me.
Tell us first, what are the implications of this government shutdown in the U.S. for global bond markets?
So first, the shutdown will happen or will start in a few hours if Congress does not agree on these appropriation bills, which is really a set of spending bills. So from that point, only essential government spending continues and other more discretionary programs are on hold. We expect that if that is the case, based on previous experience, there have been shutdowns in the past, then the impact will be largely local around Washington, D.C. and the area for contractors and government employees that do not receive the payments that they would have otherwise. Of course, the implications will depend on the duration of the shutdown, and at this stage, we really don't know.
The fact that we're not getting these economic numbers that we should be watching very closely, labor data, payrolls, BLS, the last time that they delayed this release was in 2013, and that was during a 16-day shutdown, and it took 2 weeks for them to come out with it. The implication is for the Fed's decision-making. Is this a big concern?
So that does introduce a bit of uncertainty and potentially some market volatility, as you said. So the BLS, as a government agency, would not be releasing data and then would catch up afterwards with the data collection and data release. So the Federal Reserve, as well as market observers, would not receive these data points. We'll have to see, depending really on the duration of shutdown, again, what data releases are on hold. For the Fed itself, it is the case that the decisions are based on a range of indicators, so it is unlikely that really one data release being delayed is having a significant impact.
Does it also surprise you how resilient growth has been so far in the U.S.?
Yes, so our expectation for U.S. growth this year is that the economy will slow to around 1.5%. And as you said, we have seen some relative resilience to various announcements and in particular adjustments to higher tariffs globally. We attribute that to really momentum on investment in a number of areas, in particular in the technology areas, data centers and other sectors where companies that have really relatively sound balance sheets are ready to really put investment forward. We do expect the slowdown to continue, and so next year we are looking at another year of growth around 1.5%, which will be below what the U.S. potential is typically estimated at, and below what we were expecting prior to really the range of policy announcements on tariffs and other measures.
What is this going to mean for Asia? How might this shape monetary policy and the credit landscape?
So for Asia, really at this point, it's really the set of economies in the region that have thrived on really the extension of global trade over the past decades. These economies are adjusting to a higher level of tariffs and some degree of uncertainty around the reshaping of global supply chain. We have, in general, revised our growth expectations down in the region for this year, but in particular for next year. We think that really the effects of these changes are still coming through and will be more tangible in the course of next year. You mentioned interest rates, and we think that central banks in the region in general will continue to ease monetary policy. Inflation expectations are well anchored. The exception is the Bank of Japan, of course, where normalization of interest rates continues, and there we're looking at monetary policy rates to rise towards 1% or thereabout in the course of next year.
Should we be more concerned about the super long end of JGBs right now, given that we also heard that the Bank of Japan is scaling back those purchases, and we saw already the incredible sell-off in that sector?
You're right. We've seen some periods of volatility at the very long end, around the 30-year, 40-year mark. On the whole, though, we have been really positively surprised about how smooth the BOJ's exit from the zero interest rate policy has been. It seems to be really happening gradually, but at a steady pace, and markets are really onboarding that. So there might be periods of volatility, but we do not expect that to be significant.
Is that sort of the case across the world right now, given the ongoing fiscal concerns, whether it's France, whether it's in the UK, in London, where you are, where we continue to see the volatility on gilts as well? So
there are concerns, you're right, that government debt in general is high, in particular amongst advanced economies. You mentioned the UK, France, and the US is in the same situation. And in particular, governments that are really constrained in addressing demands from the population in general for social spending, addressing cost of living increases in the past few years, new demands, for instance, defense is a growing area of spending, and so managing budgets in this situation is challenging. So that comes with periods of again volatility, uncertainty, potentially around policy statements. In the UK, there's a forthcoming budget announcements that is probably attracting some attention from markets.
Yeah, we'll be watching that one too. Marie Diron, good to have you with us, Managing Director of Global Sovereign Risk at Moody's Ratings, joining us today here in Tokyo. More ahead on the Asia Trade. This is Bloomberg. As expected, the bill to avoid a government shutdown in the U.S. has failed to pass the Senate vote, and this would really lead to that deadlock over spending, now potentially shutting down U.S. government services. We're talking about just being hours away from that midnight deadline in Washington, D.C. This would be the first government shutdown since 2018 during President Trump's first term, that also saw the longest on record of funding for the government lapsing for 5 consecutive weeks. Of course, some of the issues at hand: Democrats seeking the extension of healthcare subsidies and reversal of Medicaid funding cuts. We'll continue to watch the market reaction across Asia, especially on the sovereign debt space. Avril.
Yeah, Shery, and among the companies also that we'll be tracking, they include Nike. The shares there up in late trading after reporting quarterly sales and profit that beat expectations. Efforts by CEO Elliott Hill to realign the company around certain sports such as running and basketball, those efforts seem to be paying off. For more, Bloomberg Intelligence senior analyst Poonam Goyal joins us from Princeton. So, Poonam, what is the winning strategy here from Nike, as it looks like that turnaround effort is paying off?
Yeah, the turnaround effort is absolutely beginning to pay off. And it's really just back to the basics, back to focusing on the consumer, back to focusing on product, and back to making sure that they're where the consumers want them to be. It's a very simple return to the basics, and the execution is paying off.
The company is also returning to Amazon. What are the implications of that and the sort of clients that it wants to appeal to?
I think Nike just wants to be where the customer is. And with Amazon, clearly there's a lineup of customers that love the Nike product. What's new to this relationship, unlike when it was there prior to 2019, is that all Nike products can only be sold on Amazon from Nike. So it is almost an exclusive arrangement where Nike has its own shop so that the products are authentic and they're verified. And I think that's what makes it more appealing for Nike to come back to Amazon. But it's not just Amazon. Nike has come back to wholesale in such a more meaningful way. And we see that that was the right move because as you saw in the quarter, wholesale channel sales were up 7%. That was against an estimate for them to be down 2% for the quarter. So clearly doing well and the right strategy.
What does this also perhaps tell us about the resilience of the U.S. consumer, even in the face of tariff uncertainty?
Yeah, I think, look, the U.S. consumer is somehow still holding strong. They are spending, but they're selectively spending. So as long as you can give them the product that makes sense to them and what they're looking for, they're still shopping. So that gives us confidence that consumer spending could still continue into the holidays, which we think is a clear plus point for retailers entering the next 3 months of the year.
Poonam, thank you. Bloomberg Intelligence Senior Analyst Poonam Goel for us there. Now, Amazon has unveiled an updated line of products aimed at challenging Apple in the AI era. The company introduced enhanced smart speakers, ebook readers, and TV accessories, and these are all powered by AI and integrated by Alexa Plus. Amazon Senior Vice President of Devices and Services, Panos Panay, spoke to Bloomberg about the latest offerings.
A lot of times we take out our phone, we get distracted. I'm at the dinner table with my kids. We have this idea that we want to keep our phones down, right? Because we want to be present with each other. And there's so many times where you pull out your phone to answer a question, almost like you just said. But now it's just changed. It's completely different. Just say Alexa, have the conversation. It's quite literally all the information there, and it's conversational. Not only that, she can then get the next thing done for you.
Bloomberg's Mark Gurman has written, and it's based in part on a conversation with you, that Amazon's overhauling its devices to take on Apple in this AI era. Do you agree with that?
I haven't seen it, Ed. Can I say that? Let me read that article. Here's what I'd say. We build our products for our customers. And for people. My whole goal is quite simple. We want AI to be useful for people. End of story. And I think we're building devices to do just that. And I do believe they're beautiful. I think they fit in the home. I think they're so well thought through that when people use these devices, Ed, they're going to love them. They're just going to love them. I can't, this is something I just want people to get their hands on them.
Now is the Amazon Senior Vice President of Devices and Services speaking with Bloomberg's Ed Ludlow. Take a look at how markets are trading. We had seen, of course, the U.S. cross assets and the S&P 500 gaining a little bit of ground in the previous session, but all of this ahead of a potential government shutdown. That bill to avoid the government shutdown has failed to pass the Senate vote as expected, and that deadlock over spending could paralyze many U.S. government operations. We're talking about that midnight deadline in Washington coming up in just a few hours. We had seen pressure for the U.S. dollar amid this background as we continue to see also labor data potentially showing a little bit of more fading in recent weeks. This is Bloomberg.
We're watching developments on Capitol Hill where a Senate vote has failed, that bill to avoid a government shutdown. And of course, as we keep tabs on what we're seeing cross assets, it's really interesting how U.S. stocks have pretty much shrugged off these developments. You're hearing there from Chuck Schumer speaking on Capitol Hill. But by all accounts, it seems like the U.S. government is hurtling towards this shutdown, which could have have implications for U.S. financial markets. Bloomberg M Life strategist Mark Cranfield joins us now for more on this. So, Mark, you look at stocks, they seem to be running ahead, maybe futures pointing a bit lower at the moment. Bond markets seem to be behaving a bit more rationally. What is your sense of the financial market implications?
I think investors are largely expecting that it won't be a very long shutdown. So they're pretty much looking past it to the bigger picture issues. So in terms of equities, it won't be too long before we get into the earnings season. And people will be fairly optimistic that it's going to be another decent run, particularly for the tech and AI themes. So people won't be giving up on their stock positions just yet. In terms of the other assets, the US dollar is the most vulnerable, because clearly it's been a fairly belligerent speech from both sides here. They don't seem to want to get round the table just yet. And that likely in the very near term, that means that some government people will be laid off. That's poor for the economy. And that will undermine the US dollar and obviously take yields down to some extent as well, which is self-reinforcing from the dollar's point of view. So providing it's a relatively short-lived shutdown, the pain to equity markets won't be too much. If it goes on for, say, a month or even longer than that, it's a different ball game altogether, and the dynamics will change dramatically. In fact, the equity market will certainly have a good excuse for performing more poorly, even if the earnings season is a decent one. So it's really trying to game the scenarios in terms of how long the shutdown will last and whether the layoffs that come from it, are they temporary or are they going to be permanent? That's something that people still need to judge. But in the very near term, the themes that we've seen over the past few weeks aren't going to change very much. And particularly the AI-related sector seems to be fairly immune to what's happening in the broader economy anyway.
Yeah, that AI theme really leading to concerns about valuations, right? And this extended bull run that we're seeing, and stocks ending the strong quarter with the best September in 15 years. I mean, you said it, potentially shutdowns have not been that meaningful for the equity markets. But given how stretched we are, how big are the concerns right now?
I think anything which brings people back to the suggestion that overvaluation has really reached a point where people have to say, okay, it's time to really cash in a big way. We've been talking about high valuations for some time. What's helping the US to a certain extent is the fact the rest of the world is catching up, particularly here in Asia. We've seen this massive rebound for Chinese equity. So although it looks expensive in the US, China is beginning to catch up as well. So it's not a single theme. Last year it was all about the US. We had this no alternative theory that US was the only place to play. That's starting to spread out now. So the rest of the world, Europe and Asia especially, are beginning to take up some of the slack. So that in a way helps the US situation. But you can't avoid the fact that valuations are very stretched. Now the earnings season will be very important from that point of view. You take a company like Nvidia. Nvidia's been a star performer for most of the recent earnings seasons. If there's a letdown from somebody like Nvidia or one of the other big names like Microsoft or even Alphabet, that would certainly send shockwaves across the equity market. That's not the base case for most people, but if we get a surprise from one of the major companies such as Nvidia, that would be the turning point for a lot of people in terms of they will feel that it's no longer justified to stay with a market which is very expensive in historical terms.
Mark, while you were speaking, we've gotten word that the White House says that agencies should commence their shutdown plans, of course, as we wait to see some of the implications in terms of disruptions for government services. It's really interesting how, when it comes to U.S. policy, we went from earlier in the year that uncertainty playing out on the long end to now how supply fixes have tamped down those concerns. What are you seeing in terms of the curve flattening trade that now seems to be coming back to the fore?
Yeah, I mean, this will encourage people to stretch for yield. If there's going to be a shutdown which is going to affect the US economy, people want to grab treasuries as much as they can. to get the yield they need, they'll have to go further out the curve. So instead of looking at just 10 years, they probably got to look as far as 30 years. So that will help to flatten the curve from the long end. They're also getting support from Japan. Japan has been one of the yield curves which has disrupted G10 markets in general, but we're seeing a lot more stability at the very long end of the curve there. In fact, overnight, the Bank of Japan just announced that it will be providing a little bit more support for the very long end of the Japanese curve by maintaining purchases. Even though it's going to trim purchases around the 10-year sector, it will stay with the super longs. So we'll probably see more flattening from the 30, 40-year sector in Japan. That will help the US market and help the European markets. So all in all, we can expect that curves will generally flatten in the G10 space, and that will include treasuries.
Bloomberg M-Live strategist Mark Cranfield there with the implications of that government shutdown in the U.S. And these are some of the stocks that we'll be watching when trading gets started in Australia, Korea, and Japan. Drug makers in Australia and Japan in focus. Pfizer securing a reprieve from President Trump's long-threatened tariffs on the pharma industry by agreeing to slash some of its drug prices by up to 85% and sell directly to the American public. Other major drug makers expected to follow this move. And take a look at how we're trading when it comes to the news of Prime Minister Albanese now reacting to China's ban on BHP iron ore cargo, saying that that this is quite disappointing. Remember, we had seen iron ore advancing after China's state-run iron ore buyer told major steel makers and traders in the world's largest importer to temporarily halt purchases of all new BHP group cargoes. We saw futures of steelmaking staple climbing by more than 1%, and now Prime Minister Albanese in Australia saying that this China ban is disappointing. This is Bloomberg. Data center power load has more than doubled since 2020, according to data from Bloomberg NEF. This growth is expected to accelerate over the coming years as the largest data center operators ramp up capex in the U.S., which is the leading market. Other large markets include Malaysia, France, India, Germany, Japan, and the U.K. Our next guest runs Stonepeak, an alternative investment firm specializing in digital infrastructure, which manages over $76 billion. Joining us now is Chairman and CEO Mike Dorrell. Mike, great to have you with us. I mean, with anything related to AI or AI infrastructure, there are still some concerns about valuation given the exuberance right now and perhaps the energy need expectations at this point. What's your assessment on the ground?
I think that's probably fair. I think that, and from a valuation standpoint, certainly the trends driving all this data center build, they're real, okay? So you go back historically and every forecast of how many data centers we'll need has been wrong. And it's been wrong because it's been underestimating the amount of capacity we do need. So I'm a big believer in the long-term growth trends in terms of assets on the ground for data centers. But I do think it is fair to say that there is a lot of exuberance around that space. You know, we'll see whether valuations are justified over time, but you'd certainly need a pretty smooth continuation in the AI trend and the cloud trend without too many bumps in the road in order to, underpin the valuations we see today. On the other hand, if you're going out there and building new data centers and doing that on the back of long-term contracts from the big tech companies, and that's what the data center players are doing today, I think there's incredible investment value there. Just to put that in perspective, you can build a new data center in Asia, in the US. It just differs a little bit between markets, but call it like somewhere between 8 to 12 times earnings. I think that works out quite well. You go and buy a big platform though for 30 times. You just need more to go right. So I think your concerns, it's certainly worth consideration for sure.
I was going to say, I mean, are the concerns over a bubble in data centers justified in every market across regions? Do they vary? And where do you see the opportunities then?
I wouldn't go so far as to call it a bubble in data centers. Again, I think the trends are very real. I do think the build economics are very strong for data centers. So I wouldn't go so far as to call it a bubble, but certainly there's a lot of exuberance around the AI and data center space. I distinguish a little bit between markets. If you look at the historical data center market, both in Asia and the US and Europe, it's been heavily cloud driven, and cloud growth has been very strong. So cloud growth for a decade or so has been in the 20 or 30% range. So that's been a very strong underpinning for a long time. AI has certainly put, rocket fuel on that fire. If you look at AI globally, today, most of AI is in the US. So something like 3/4 of GPUs in use globally are in the States. And then, the next biggest country is China with something like 15% of the GPU usage. Between US and China, that's 90% of GPUs. So there's a big gap between those two countries and the rest of the world from an AI standpoint. But certainly cloud growth in Asia
sorry to
is
jump in
incredibly
there.
strong.
Just picking up on that point, right? Strong in Asia, it looks like. But still, the concerns remain about whether there's going to be more AI capacity than will eventually be required. So in considering, this optimism in Asia, what are you using as your sort of metrics to consider which markets to be expanding in?
So we look at build economics. Everyone's got their different approach, but from our standpoint, we're very big on asset creation in all the markets we're in. We just tend to find that you can build things a lot more cheaply than you can buy them for. So we look at build economics. So build economics in the US before AI were okay, but not amazing. Since AI came into being, build economics have improved enormously. So, in real estate terms, cap rates for a new data center in the US were 6 or 7% before AI. Okay, but not all that enticing. Almost overnight, once AI came into the market, those cap rates jumped up into the double digits. Early on when there was real a gold rush for those who had power, you were seeing cap rates of 15%. I mean, that's incredible with these big, strong technology companies, your counterparts. They've come down a little bit in the US, but very, very good cap rates for new build. In Asia, similar, if not higher in Asia. So we've been very happy with what we've seen in terms of the economics we get on building new data centers. And, you've got good contractual backing there. If the market backs off for a while, well, you've got long-term contracts with the technology company. So I'm not too worried from our standpoint if that bubble does, if there is a bubble and if that bubble does burst for a period.
Mike, just wondering as well, what are you seeing out there in terms of the sentiment among large investors towards infrastructure investing? What sort of shifts and trends are you seeing?
There's been a good trend into infrastructure for some time, partly because it's a more nascent asset class. It just doesn't have the history that, say, real estate or private equity investing does. So there's just some natural catch-up there that's been taking place. But on top of that, there are some real mega trends globally at the moment that are big supporters of infrastructure investing. And there's probably 3 of those I'd call out. There's the digital revolution that you've already touched on, of course. That's trillions of dollars of investing over time because of that. You've got the energy transition mega trend. Again, trillions of dollars there. And I'd note that Asia is the biggest market for energy transition in the globe. It's bigger than the US, it's bigger than Europe, so that's another big thematic that interests investors.
We
and then
will
finally,
continue
you've got all the
watching those
investing
mega trends indeed. Michael, thank you so much. It's been really great to chat with you and get your insights on infrastructure investing and the sector. Mike Dorrell, CEO and Chairman at Stonepeak. We'll have more ahead on the Asia trade. This is Bloomberg.
Activist investors are on the rise in Japan, with Yoshiaki Murakami leading the charge. Data compiled by Bloomberg shows provocateurs staged a record 146 campaigns in the country last year, more than twice the number 4 years earlier. Let's bring in Bloomberg finance and investing reporter Lisa Du for more on today's Big Take. Lisa, I guess get us started with a look at who Yoshiaki Murakami is and his significance in this space.
Yes, so Yoshiaki Murakami is a very well-known, very controversial Japanese investor, kind of with a reputation for his very aggressive tactics, but also just how profitable his investments has been. He's Japanese, but nowadays he's based in Singapore. And Murakami's background is essentially he started his career as a government bureaucrat in Japan, and this was a job that really only went to the most elite and the smartest. And in the late 90s to early 2000s, he quit that job to become an activist investor. And this was essentially taking large stakes in companies, asking them to increase dividends, do buybacks, things that were seen probably as quite commonplace these days, but back in the day was extremely controversial in very conservative corporate Japan. And he was kind of made even more controversial because in about 2006, he was arrested and charged with insider trading. And this related to a company that's now known as Fuji Media. And these charges were appealed and some of them were dropped, but he kind of took a break from investing for a bit and reemerged about a decade ago. And the last kind of 5 years has really picked up the speed of his investments. He's now operating as a family office, investing with his daughter, and from our data crunching, we've seen that they hold over $3 billion in positions across dozens of Japanese companies.
Lisa, he's controversial but also influential. What does his comeback success signal about Japan?
Yeah, so I think it really says something that about 20 years ago, what Murakami was calling for was kind of really seen as a no-touch zone. Things like, just doing more share buybacks, increasing the dividend, and these are really now commonplace. You see very well-known activists like Elliott Baluak asking these things of very storied Japanese companies like SoftBank, like Seven & I, and he was really the first guy to do it. One analyst we talked to called him the grandfather of Japanese activist investing. And I think a big question a lot of investors have been asking, about with Japan markets at a record high almost every day is kind of how sustainable is the Japan comeback. And the fact that kind of what Murakami was doing back in the day, what was so controversial, is now seen as commonplace, may suggest that some of these changes in corporate Japan are really becoming more sticky. The other fact that why he's been so influential is that because he's been doing it for so long, he's influenced multiple other funds. For example, Ifissimo, which is a very well-known fund in Japan, very influential in the buyout of Toshiba a couple years back. The guys that started that fund worked for him, and he's also investing now with his daughter, who has a reputation of her own, known also to be very aggressive, working together. So I think even we can expect not just Murakami but his family to be influential in Japanese investing going forward.
Lisa Du, Bloomberg finance and investing reporter there, and we keep you here in Japan because we are getting the latest breaking numbers on the Tankan survey for the third quarter. Large manufacturers index coming in at 14, which is as expected, but also improving from the previous quarter. When it comes to the manufacturing outlook, 12, same as the previous quarter. The non-manufacturing index in the Tankan survey, 34, in line with estimates and just at the same level as in the second quarter. The non-manufacturing outlook at 28, which is a slight improvement. And of course, we have to contend with the fact that we have mixed effects of U.S. tariffs, where we saw really that 15% tariff weighing on manufacturers, but that 25% tariffs on car makers and suppliers being lowered to 15%. So a lot that these businesses have had to contend with. Let's bring in economics and government reporter Yoshiaki Nohara, as we're also seeing the all-industry capex estimate 12.5%, which is also an improvement from the previous quarter. Yoshi, why are these numbers so important, especially when it comes to the trajectory of the BOJ?
Well, Tankan is one of the key indicators that the Bank of Japan is looking at as it considers its direction of policy making, because it shows that how the companies are feeling about everything, including the U.S. tariffs and slowing global commerce conditions.
What does this mean for the BOJ? I mean, this is ultimately something that we watch for the path of the central bank.
Well, these are pretty solid numbers for the Bank of Japan. So in other words, these numbers will probably help the bank to say that they're on track to consider another rate hike. Whether the timing is going to be in October or not, we don't know. But earlier this week, we had one of the dovish members of the board members say that he sees a need, rising need for interest rate hike.
Yoshi, we have continued to watch the Bank of Japan's normalization policy. They're now scaling back their purchases of especially super long bonds. This is why these auctions of JGBs are so important, right? And the 2-year auction didn't do very well this week.
Well, tomorrow we are having the 10-year JGB auction, which is a really important one because it's considered as a benchmark for the impact of the real economy. 10-year JGB yields tend to be linked to fixed mortgage rates, which have a direct impact on the people's livelihoods.
Economics and government reporter Yoshiaki Nohara there, joining us with the latest on the Tankan survey. Very important numbers when it comes to the trajectory of the Bank of Japan. And of course, as we continue to watch the Japanese yen, which has been a little bit supported against the U.S. dollar, given, of course, the weakness of the greenback on the U.S. government shutdown looming just hours from now. We have seen that bill now failing the Senate in the U.S. when it comes to funding the government, which some say would lead to more greenback weakness and actually help the likes of the euro and potentially the Japanese yen as well. Of course, we continue to see safe haven demands among other assets as well. Gold expected to retain its allure as a haven given the implications of a government shutdown. And we continue to watch the equity space as well as the Japanese markets has been under a little bit of pressure in the past 3 sessions. As we head to the market opens, we're not just watching those auctions, as Yoshiaki mentioned, the 10-year auction coming out, the very weak demand of the 2-year auction yesterday, but also just JGBs in general, given that the Bank of Japan is scaling back the purchases of super long bonds. And the third quarter Tankan survey now showing some resilient business sentiment and some of those indices actually improving from the second quarter. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg.
This is the down to Asia's major market opens, and we just had a reasonably good Tankan survey. Appears to potentially clear the way for more tightening from the Bank of Japan, but of course, Avril, the big long shadow being cast over everything at the moment. The US shutdown, government shutdown, seems pretty much unavoidable now.
Yeah, we are hours to go before that deadline. And given how that Senate vote failed, we are approaching what could be a U.S. government shutdown. But what is interesting is how stocks overall, Paul, they seem to have been shrugging off that risk.
Yeah, not too much concern about that at the moment. Perhaps an expectation that it's not going to last terribly long. But here we go. Markets now opening in Japan, Korea, and here in Australia as well. And I just want to start with some breaking news as well out of South Korea. We've got trade numbers for the month of September. We've got exports rising 12.7% on year. That's a beat where we were expecting 7.8%. Imports also ticking up to 8.2% on year, also more than expected than the 5.6%. The trade surplus widening to $9.5 billion. So a healthy set of trade numbers there from South Korea for the month of September. If we take a look at how things are tracking in Japan at the moment, we've got the Nikkei off by 1/3%. The yen still holding pretty steady around 148. This is after the Tankan survey, viewed as a key piece of information for the Bank of Japan as it heads into its decision whether or not to tighten. Seems like buyers bias would be now for some tightening to go ahead. The path now seems clear after business sentiment climbed to 14 from 13 in the 3 months prior. Also in the survey, those large manufacturers see the yen strengthening to 145.61 this financial year. Let's take a look at how we're doing in Korea after those trade numbers as well. We've got the Kospi better by 0.2%, just to recap for you. Pretty decent set of trade numbers there out of South Korea, the surplus widening to $9.5 billion. Here in Australia as well, a little bit of weakness creeping in early on, and we are going to be keeping an eye on the fortunes of the world's biggest miner, BHP, because China has banned new BHP cargoes over a price dispute. New deals can't be signed even for cargoes that are already at sea on their way to China. Meetings last week really failed to provide a breakthrough here. We've got BHP shares a little bit weaker in the early going, off by 1.2%, and the broader ASX softer by about 1/3%. All right, well, let's get back to the top story of the hour and an update on that looming US government shutdown with Bloomberg Congress reporter Alicia Diaz, who is on Capitol Hill. So, Alicia, what's at the heart of the impasse here? What can't the two parties agree on?
So the biggest thing right now is Democrats are pushing for an extension of Obamacare healthcare related subsidies, which are set to expire at the end of this year. Republicans, on the other hand, mostly for political reasons, say that they won't support something that extends more spending and specifically more spending on Obamacare. So that is one of the biggest impasses here. And we have yet to see a crack begin to shine through for the negotiations. All signs right now point to a very likely shutdown at midnight tonight. And it remains to be seen if, either side will come to the table and offer something as some sort of negotiation to get a spending bill through the door.
What's at stake here, both politically and economically?
So, of course, President Donald Trump has said that he could fire some of the federal workers who are furloughed. Of course, typically during a government shutdown, federal workers, many of them who are deemed non-essential to human life or to property, are sent home and, continue to be employed but aren't necessarily paid. So the stakes are a lot higher this time. Of course, if this happens and there's another round of, mass firings for federal workers, that could really blow back politically for either party. And so it remains to be seen, the stakes just at play here.
Who's going to wear the blame for this ultimately? Because, of course, the Republicans hold a majority in all the houses, as well as the White House also. So in terms of shifting the blame around, where's it likely to end up?
That's a great question. I think both parties, of course, are hoping that it plays in their favor. Very early polling from Politico showed that it's likely that some people do blame Republicans because that they are in power, because the president is a Republican. They kind of see that party as the one who has the ability to change and maneuver here. But then again, Republicans are saying that Democrats are the ones who are holding out on this. They're the ones who are making demands, quote unquote. So it is kind of a political back and forth. And there are big stakes here, both economically and for the midterms in 2026.
Alicia, thanks so much. Bloomberg Congress reporter Alicia Diaz for us. Let's get more on the potential market implications with Noriko Chen, management committee member and equity portfolio manager at Capital Group, which manages more than $3 trillion in assets. She joins me here at the Milken Institute Asia Summit. So great to have you, Noriko.
Yeah, thank you so much for having me here. I'm based in San Francisco, but I lived in Asia for 23 years. So it's a delight to be back.
And you're a longtime investor in Asia as well. Let's start first on the topic of the day, though, that looming U.S. government shutdown.
Right.
It's so interesting how global equities have shrugged that off. And for this year also, the tariff risks. What are you seeing in the nearer term outlook? Is there enough momentum to carry us into the end of the year?
So I think that there are definitely implications on the economy from both tariffs and also government shutdown. But the reason why you're seeing the market kind of disregarded a little bit is because in general, we've been through many government shutdowns in the US. In general, they last for about 9 days. And the rule of thumb is 1 week is about a 10 basis point impact on the economy. And so usually they don't last that long. So really we'll be watching to see how long it lasts. But generally, markets do tend to rebound back. It's also happening much earlier than the next political cycle, election. So probably not, significant impact on politics short term. And so, for us as long-term investors, we actually see this market volatility as opportunities to invest in higher conviction ideas.
What are some of those conviction ideas?
Higher conviction ideas, yes. Well, this year, we've seen a lot of diversification, I think, has been really the term this year. We're seeing a diversification of the markets. So this is the first time since the GFC that you've seen, massive fund flow into international markets. And the international markets have done much better than the U.S. markets. So emerging markets up 27%. You have MSCI World, Japan, all up more than the U.S. And I think it's because fund flows are going to where they see attractive opportunities. And we're seeing, a lot of earnings growth upsides in sectors like European banks. We're also seeing a lot of opportunities in government regulators basically coming out and saying that they want better corporate governance for their companies and their countries. And we're seeing that in Japan. We're seeing it in Korea and China. And, when you have governments telling you, the regulators telling you that they want their companies to be, structurally more healthy and also more profitable with returns to shareholders, that's usually a very good thing for investors. So that's also something that I'm very constructive about.
Particularly for China, a lot of this is also driven by the AI theme. How much exposure do you have to that? Are you looking to increase that a bit more?
So we have invested pretty broadly behind the entire AI stack at Capital Group, but we've been doing that for several years now. So we do think that AI is kind of the next mega cycle. If you think about the potential TAM, the total addressable market for AI, short term, it's supposed to be about $2 trillion US. But if you think about the entire global GDP, which is about 100 trillion and 50 is labor. You can see what the massive potential upside is. So that's why you're seeing significant investment in AI, from infrastructure to the data centers, because it costs a lot of money and investment in order to build these LLMs, the models.
Okay, what's also interesting is when you look at US versus China tech, all these concerns about lofty valuations in the US, are you seeing that as a risk? Is that something that you are putting into your metrics, your calculus?
I think of it more as less top down and more kind of bottom up. So for a lot of the companies, they're actually growing into their valuations, and that's really what's happened with companies like NVIDIA over the past several years. The valuation looks optically high, but then they're surprising on earnings estimates. And so, at the end of the day, the valuation is less high. And I think it's the same for the U.S. market. The U.S. market is trading at like a 24 times current PE, but when you deconstruct it, it's about 30 times for the Mag 7 Plus, and it's 20 times for everybody else. So there are a lot of companies, even in the U.S., that look pretty attractive from a valuation
Which is quite remarkable given what we saw post-Liberation Day, for example. Do you think we can say that the Sell America theme has come to an end?
I don't know if it's a sell America. I think it's more of where are opportunities, right? And right now, there's a lot of investment going into AI globally, but also a lot of investment going into, for example, defense in Europe and Asia. There's a lot of investment going into AI in Asia as well. And so, and also, we see a lot of capital appreciation in sectors where the companies are basically trying to become better quality companies, reducing loss-making businesses, returning capital to better capital allocation and shareholder value. So that's kind of where we're seeing fund flows and opportunities. So it's less one versus the other. I think it's really kind of identifying where the attractive opportunities lie.
Among sectors, what's also been interesting is what we're seeing in gold commodities. That's really underpinning some of these mining stocks. Is that something you're looking at as a trend that you can position for longer term, perhaps?
Well, I think there are a couple different things happening with the various mining stocks. I do think that some of the mining stocks, like copper, are leveraged to EV and to some of the new technology, and I think that's one of the reasons why they have done well. And it's, as you know, it's very difficult to operationally execute. And so there aren't that many companies that can do it well. For gold, we're seeing a combination of market volatility, and so that's why people are using kind of gold as a safer haven. I think that might last for a little bit longer, just because, again, we have a lot of market volatility with the tariffs and with the government shutdown and, kind of reciprocal tariffs. So it's probably unlikely to change short term. But also the companies are getting better, they're better operationally, better with capital returns. And so, it's a combination of multiple different factors.
And it also, I think, amid the volatility, and that's why gold is doing well, is, drawing things back to the basics of active management. Right. How do you, view the landscape, and how does that help position for the future?
Yes, well, the fund that I'm in, New Perspective Fund, actually, the objective is to benefit from changes in trade, in global trade. So as you can imagine, we've been incredibly busy over the past several years as trade has changed so dramatically. And we do think that there are going to be some longer-term secular big changes in trade that's happening, not just this year, but has been already shifting from, I would say, 2018. And then COVID probably facilitated, that fast-tracked that shift. So, we are finding through changes in trade many opportunities to invest in companies that are benefiting from those changes.
Noriko, it's been so good to chat with you. Thank you so much for your time.
Thank you so much.
And sharing your market insights with us. Noriko Chen is Equity Portfolio Manager at Capital Group. Paul?
All right, thanks, Avril. Let's just check in on a couple of stocks that we're watching. BHP continuing to slide in the early going here in Australia, now off about 1.8%. This is after China announced it would ban new BHP cargoes over a price dispute. This means new deals can't be signed. It doesn't even matter if those cargoes are already at sea and on their way to China. So some difficulties there in the relationship between BHP and its Chinese customers weighing on shares at the moment. Want to check in on pharmacy stocks as well. This after the news that Pfizer got a reprieve from tariffs from President Trump, agreeing to slash some of its drug prices by up to 85% and sell directly to the American public in exchange for a 3-year grace period from pharmaceutical tariffs, perhaps coincidentally 3 years remaining on President Trump's term as well. Not to worry, however, this is supporting pharmaceutical stocks across the region at the moment. Chugai Pharmacy up by almost 3% at the moment. More ahead on the Asia trade. This is Bloomberg. Get some breaking news for you. South Korea has agreed that it's going to share its monthly foreign exchange intervention data with the United States. So this will be shared on a confidential basis. Right now, FX intervention data is currently disclosed on a quarterly basis, but both nations are now agreeing to publish the annual currency composition as well. Both sides reaffirming they will not manipulate exchange rates for competitive advantage. So South Korea agreeing to share its monthly FX intervention data confidentially with the United States. This is according to a joint statement. So that news just breaking now. And we see not a great deal of change there for the won at the moment. I want to check in on how the yen and Japanese bonds are tracking as well. The yen softening again a little bit, 148 just below that handle now. We did, of course, get the Tankan survey out of Japan, and we saw some reasonably good business sentiment improvement there, climbing from 14 to 13 in the 3 months ending September. Also for large non-manufacturers, the gauge remaining unchanged at 34 from 3 months away. The survey also finding that the manufacturers see the yen strengthening to 145.61 this financial year. With a little bit more on this, let's get to Japan economy and government reporter Erika Yokoyama. So Erika, what were the key takeaways from this Tankan? It looks to be fairly strong.
Yeah, that's right. So today's Tankan data, I think it points to a solid corporate sentiment, especially among the large manufacturer. I think that backs the case for the Bank of Japan's rate hike as soon as October. You probably remember the Governor Ueda emphasized last month the needs to assess U.S. tariff impacts on business activity as well as inflation trend. And I think today's surveys just tick one of the boxes, the business activity. And as you know, this is the first Tankan survey after the US and Japan reached the trade agreement in July and implemented in September. And although the new tariff rate is slightly higher, actually quite higher than the level before the Trump's administration, but I think companies appears to view the situation as better than the previous uncertainty when the US threatened Japan with 25% tariff on Japan's exports. And of course, solid corporate sentiment is a positive sign for the wage growth momentum, especially because the next round for the wage negotiation kicks off later this month as well. So I think overall today's data will add fuel to speculations of the rate hike sooner than later.
And I think bond market participants are sensing that already, given how weak the demand was for the 2 years earlier in the week. What are we seeing in JGBs, not just on the short, but the long end as well, given how there are some of these measures to curb supply?
Mm-hmm. Yeah, so bond is also seeing some pressures as well, just because like the market expecting more chances of the rate hike probably in October. Then that was partly because of the inflation getting strong. As you said, one of the dovish member, Noguchi, said this Monday that Japan is making progress towards the 2% inflation target. And it's kind of rare. He mentioned the needs to consider the rate adjustment as well. And, today's Tankan also has the data for the inflation as well, which is inflation expectation in 5 years, which was 2.4%. That's like the highest level data going back to 2014. So I think that the Japanese companies expect inflation to persist for some time. And, going ahead, more speeches coming from the board members as well later this month. So yeah, the bond market participants have a lot to see before the next the policy decision.
All right, Japan economy and government reporter Erika Yokoyama there. Well, Australia's Prime Minister says Beijing's ban on new BHP cargoes is disappointing. Anthony Albanese says he wants Australian ore to be exported to China without hindrance. Let's bring in our China correspondent Min Min Lo now. So Min Min, what led China to banning these iron ore cargoes from BHP?
Yes, it's a price dispute that is ongoing, and we understand from sources that the China Mineral Resources Group, that is a state-owned company that is set up by Beijing to centrally manage the country's purchase of iron ore in order to better negotiate for prices. That company has met with BHP several times, but obviously they didn't come to a good, mutually beneficial agreement, I would say. And here you can see BHP stock down by about 1.7%. We understand from sources that the China Mineral Resources Group has told domestic producers to halt purchases of cargoes, seaborne cargoes from BHP, especially dollar-denominated ones. So this means that no deals can be signed, even for cargoes that had already sailed away from Australia. The only ones available for purchase now are those that had already arrived in China and are denominated in yuan. And this is, of course, a big blow to Australia, which is by far China's largest source of iron ore. And obviously China is also one of the world's, or in fact the world's largest iron ore producer. And you can see the impact here on iron ore prices rising as a result of this.
Yeah, talk to us about how this is likely to push up iron ore prices.
Yeah, so we already see the immediate impact here, and I think this is something to continue to monitor because some analysts believe that it is going to fizzle out at some point because given the relationship between China and Australia and the importance of Australia as a source of iron ore, there is a belief that both sides have equal motivation to try to resolve this. But one of the side impact of this is also the collapse in freight prices because iron ore is a big component of dry bulk shipping, and you can see the dry bulk index, which we can show on the screen, already seeing a decline today as well. And so this is something to continue watching, especially given that China is now in the Golden Week holiday. There is another 8 days where businesses are closed, so perhaps it could persist for a little bit longer. But Albanese has said that he hopes that this is something that is short term that could be resolved soon, and he says this is something that could sometimes happen during price negotiation.
All right, Bloomberg's China correspondent Min Lo there. I want to check in on lithium stocks as well because we're hearing that CATL, which closed its huge mine in the Yishan city, the Jianshawo Leopardite mine, which closed last month, they might be getting a bit closer to restarting. It produces about 65,000 tons of lithium annually. That's about 6% of global output. So news of that huge mine potentially coming back online, weighing on lithium stocks today. We've got Liontown and Pilbara Minerals here in Australia off by 6 and 7% respectively. More ahead on the Asia trade. This is Bloomberg. Just getting some breaking news regarding Mitsubishi UFG Financial Group, better known as MUFG, apparently in advanced talks to take a 20% stake in India's second largest non-banking finance company, that is Shery Ahn Finance. That's a deal worth about $2.6 billion. This is according to people familiar with the matter. We're seeing MUFJ shares slipping at the moment, though, off by about 3.6% on that news that they might be acquiring a stake in India's second largest non-banking finance company, Shery Ahn Finance, worth $2.6 billion. Avril.
Yeah, Paul, here are some of the global stories we're following. The White House has pulled the nomination of E.J. Antony to lead the Bureau of Labor Statistics. No reason was given, but his nomination had come under pressure after reports of public commentary, social media posts, including sexually degrading comments, conspiracy theories. A White House official told Bloomberg that the administration looks forward to nominating a new candidate soon. President Trump, meanwhile, says his administration is close to finalizing a deal with Harvard University, an agreement would potentially defuse one of the highest profile fights between his administration and U.S. higher education. Trump initially accused Harvard of failing to tackle anti-Semitism on campus, but later broadened that to include allegations of political bias. We have more ahead on the Asia trade. This is Bloomberg.
All right, let's take a look at how the major indexes are tracking at the moment. Somewhat of a mixed picture. We've got the Kospi high by about 2/3%. We just had some pretty good trade data out of South Korea earlier. Also, the news that South Korea is now going to share monthly foreign exchange intervention data confidentially with the United States. That's according to a joint statement. The Nikkei a bit softer, off by about 0.8%. Had a pretty strong Tankan survey, which suggests the path is now clear for the BOJ to continue tightening. Here in Australia, meanwhile, the ASX just off marginally by about a 0.1%. Some of those big mining names having a tough time at the moment. BHP struggling with a price dispute with China, and lithium miners struggling as well on the news that CATL might be bringing its giant lithium mine back online. And as you see on the bottom of the screen there, casting a shadow over all of it, a US government shutdown now potentially about 3.5 hours away. Let's get a little bit more on that shutdown now, which could have implications for US financial markets. Garfield Reynolds leaves our MLive Asia coverage and joins us now. Garfield, markets seem to be taking this in their stride at the moment. What's the threshold for panic?
Well, I think the threshold for panic is hard to tell because it's a little bit unclear what we're going to get this time around. We've had, for a number of years, we've had the standard go around is that they either get right to the edge and pull back, or maybe they even go beyond it and they pull back. This time around, it looks like both sides of politics are far more willing to go for an extended shutdown. So markets are a little bit unsure how to play that, partly because, for one thing, the lack of data and the likelihood that this is going to lead to job losses in at least the short term, that seems to be being taken as meaning it's likely the Fed will go ahead with rate cuts, especially if we still have this going on by the time the Fed meets next. So that's been hurting the dollar, keeping a lid on yields. On the other hand, this could be, we've had all manner of major political blow-ups so far this year that haven't really led to sustained impacts on markets. This time could well be different, especially with the White House's budget office director wanting to not just put lots of people on furloughs, but to actually fire them. So if we do get that big level of job losses, never mind whether the Fed's going to cut rates or not, businesses might start to worry that that's going to have a real hit to demand. We are in this scenario where the expectation was that the Fed would cut rates to help the US avoid a severe downturn, because the labour market was started to show signs of significant weakness. If the shutdown ends up looking like it's going to push that significant weakness in, make that more significant, then that could be, the trigger for a major unwind. After all, we've spent a lot of time this year thinking, can equities go on being this highly valued when there are so many risks around?
While you've been speaking there, we did get a whole lot of PMI numbers out of Asia. Let's just quickly run through some of them. Japan, their PMI of 48.5. That is the lowest we've seen in 6 months. Indonesia's PMI also a miss at 50.4. South Korea's also the lowest since August 2024, and the Philippines recording not on the screen there, the lowest in 6 months as well. One bright spot also, though not on the screen, Thailand recording its highest PMI since May 2023. So a whole lot of countries in the Asia-Pacific reporting those numbers today. Just on the subject of some of these emerging Asian economies and stocks particularly, we've seen them rallying now for about 9 months in a row. Any sign of this trend abating?
Not really. The single biggest help for that is China, so China's on holiday now for a while, but the Chinese economy has shown signs of a sustained and sustainable turnaround. Certainly its equity market has been going from strength to strength, and that's not just been because of some of the perhaps successes of the anti-involution policies, but also far more importantly, its success in the AI sphere. So that is a very important anchor for emerging markets, especially in Asia, because the heft. It's been probably a support for Australia as well. China is very important for the rest of Asia, and especially a lot of emerging markets. That's part of it. There's also, the sustained weakness in the US dollar, which, sure, it did rise last quarter for the first quarter since the end of last year, but it was only a very small increase, and it is substantially weaker. The Fed is easing policy. All of that is welcome, for Asia. But there's also, the feeling that Asia's not perhaps as dependent on the US as it was before. It's being pushed to be less dependent by the tariff policies. So to some extent, at least some parts of emerging markets are seen as being less exposed to the impact of some of the more volatile US policies than Europe in particular, and also, of course, Latin America, Canada, and even perhaps the US.
Garth, what's also interesting is amid these shifts, how the yuan is closing in on the pound as the fourth most traded currency globally. I mean, what are some of the implications of this as China works for amping up the global appeal of the yuan?
Well, it adds further heft to China's efforts to make its role in global markets more in line with its role in global economy, in global geopolitics. You know, it's neck and neck with the US in terms of size of the economy, particularly if you look at purchasing parity purchasing power terms, although it's in nominal terms it is a bit behind, but it stands head and shoulders over anybody else apart from the US. It's got a fairly large stock market as far as valuations go, but the capital controls help to limit its impact on that front. So more trade in the yuan, that speaks to a greater role, you know, for China. It also speaks to, you know, the potential for the US dollar to get undermined because there are more, you know, serious alternatives to the dollar coming to the fore.
All right, so Garfield Reynolds there, who leads MLive Asia coverage. I want to check in on the oil price as well, which we haven't mentioned yet today, but there's some big moves happening here. We're seeing Brent resuming its decline, now just below $66 per barrel. And we've heard the news, this is according to people familiar with the matter, that OPEC Plus now discussing the fast-tracking of halted production. And that would come in the form of 3 monthly installments of 500,000 barrels a day. The aim of this would be to recoup market share. So that's really weighing on oil prices today. Let's get to our managing editor for commodities and energy in Asia now with more on this, Clara Ferreira-Marquez. Clara, what more do we know about where this report came from and what's the details? What's the intention for OPEC Plus here?
I think the intention is pretty much what it has been all along. You mentioned it earlier. It's really about moving from a moment where OPEC is all about controlling a price and putting a floor under the price, and it's moving towards market share and recovering market share. So what we have here is this expediting of the 1.66 million barrels, bringing that back into the market. And what you can see today is actually a pretty steady market, around $66 for Brent, as everyone tries to digest the number of factors here. So yes, we do have this OPEC report from our colleagues overnight. You also have the question of, even if OPEC were to bring this, how much will actually come to the market? How much can they really ramp up? How much can the individual countries ramp up? Is it a kitchen sink approach? So from here, are we done? In that case, it's a bit of a relief. And then, of course, there's the question of this China buying and the China strategic reserve, and how much of the OPEC barrels will China be able to absorb. So the market, I think, is digesting a lot of that today, which is why after a bit of a down arrow, you're seeing it relatively steady.
You talk of this digestion, Clara, but I think for markets also, it's this supply indigestion. It's still about oversupply, that glut. I mean, what are you seeing for prices in the mid to longer term?
So the idea of a glut, I think, is really hanging over the market. You've seen the IEA, you've seen many players in the market pointing to a very significant surplus from the end of this year and going into next. However, I would caution that the market has a way of not quite making it to those surpluses. I mean, this time it does seem, if you just count up those numbers, how much China's likely to buy, how much OPEC is bringing, how much the economy is sowing, it's difficult not to see a surplus and difficult not to see prices moving lower. But a lot can change in oil markets, so we'll have to see over the coming months.
Clara, thank thank you so much for walking us through the nuances in the energy markets on the back of this reporting about what OPEC Plus might do. Managing editor for commodities and energy in Asia, Clara Ferreira Marquez. Now, we also have some other developments to get you up to speed on. Exxon planning to cut about 2,000 jobs globally as it consolidates smaller offices into regional hubs as part of its long-term restructuring plan. CEO Diron says the reductions represent about 3 to 4% of Exxon's global workforce and are part of the company's ongoing efficiency drive. Paul?
Let's take a look at how BHP shares are tracking. They're off about 1.8%. The world's biggest miner having some difficulty getting its iron ore into China at the moment. China banning new BHP cargoes. This is over a price dispute. This means new deals can't be signed, and that means that applies to even cargoes that might already be at sea on their way to China. Australia's Prime Minister Anthony Albanese weighing in on this as well, describing the ban as disappointing and that he's concerned about the issue. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at our assets in Japan are tracking at the moment. The Nikkei off by about 0.5%. The yen continuing to soften at the moment. We did just have the Tankan survey for the 3 months to September. It made for pretty healthy reading, which leads one to conclude that the path now clear for the BOJ to tighten at its next meeting. Avril.
Yeah, we are seeing some of that reaction, I suppose, in Japanese lenders against this backdrop of expectations of rate hikes from the BOJ. The Nikkei is down today, but also focusing on Japan, given how activist investors there are on the rise, with Yoshiaki Murakami leading the charge. That's one investor that has been prominently in the spotlight recently, and data compiled by Bloomberg shows that provocateurs staged a record 146 campaigns in the country last year. This is more than twice the number 4 years ago. Let's bring in Bloomberg finance and investing reporter Lisa Du for more on today's big take. So Lisa, this is a prolific investor, controversial as well. Tell us more about him.
Yes, like you said, Yoshiaki Murakami is a very well-known but also very controversial investor in Japan. He's Japanese, but nowadays actually based in Singapore. And he's really just really well known for his very aggressive tactics and just how highly profitable some of his investments are. And his background is really Murakami started out as a government bureaucrat in Japan. This was a job that really went to the most elite and the smartest. And in the late 90s to early 2000s, he left and started his own activist fund. And this was, taking large stakes in companies, asking for increased dividends, more buybacks, things that are probably seen as very normal these days for activists. But back in the day, it was extremely controversial in a kind of a very conservative corporate Japan. And he became even more infamous because in 2006, he was arrested and charged with insider trading. And some of these charges later dropped on appeal, but he kind of took a break from investing and about a decade ago started doing it again, now kind of as a family office and working with his family. And in the last 5 years, you've really seen him ratchet up some of these investments, also kind of signaling a change in corporate Japan. And from the data we've compiled, him and his family control now, have over $3 billion in holdings across dozens of Japanese companies.
It sounds like this was an investor that was ahead of his time. What do some of the reforms that he was advocating that have since been implemented in Japan tell us about Japan?
I mean, I do think there is this kind of larger question these days about how kind of just, how sticky are some of these reforms and how is there any momentum this Japanese rally you're seeing in the market? And I feel the fact that what Murakami had asked for, 20 years ago is now kind of seen as commonplace does give some signal that some of these changes and that in Japan are more sticky and maybe here to stay for the longer term.
Talk to us also about what his track record is like, some of his prolific investments.
Yeah, I mean, so it's because they operate as a family office. It's not known public, and they have no outside investors right now. It's not known publicly exactly how much money they're making. One CLSA estimate told us that it's likely in the last 4 years, when the investments really picked up pace, they've made over $1 billion in profits. One of his most prolific investments, obviously Fuji Media Holdings. It was the stock he was in that originally recently got him arrested for insider trading, and now is kind of in the headlines again because the company has been caught up in a sex scandal revolving around his employees. But what's happened is now he's kind of back in the stock, and since he's been in it, the stock has nearly doubled this year. Usually, you'd expect a company, with going through a scandal of such to for the stock to tank, but because he's in it, it kind of shows the extent of his influence that just because he's taken a stake in the stock, people expect a lot of changes from the company.
Yeah, and it also speaks to, I think, there's this trend, it seems like investors are following what he's investing in. It's really that influence that we're seeing as well. Yeah. What are your thoughts on that?
Definitely, he is known kind of as the grandfather of activist investing in Japan, which was what one analyst called him. And because he's been around for so long, he's also influenced other investors. One very well-known fund in Japan, Fissimo, who was very influential in the buyout of Toshiba a couple years back. The two guys that started that used to work for him. Additionally, he is now investing with his family, and his oldest daughter, Aya Nomura, is his top lieutenant and has been working alongside him. Also very known for her own reputation as quite aggressive. And so I think it's not just going to be him going forward, but really the Murakami family that's going to continue to be quite influential in Japanese investing going forward.
Lisa, great stuff. Really interesting to see today's big take. Lisa Zhu for us, Bloomberg Finance and Investing reporter. We'll have more ahead on the Asia trade. This is Bloomberg.
Here's the top stories that we're tracking in the corporate world. Bloomberg has learned that Meta is acquiring chips startup Rivos as part of an effort to bolster its internal semiconductor development and control more of its infrastructure for AI work. Meanwhile, CoreWeave has signed a deal to supply Meta with as much as $14.2 billion worth of computing power. As part of the agreement, CoreWeave will provide the social media giant access to NVIDIA's latest GB300 systems. Amazon has unveiled an updated line of products aimed at challenging Apple in the AI era. The company introduced enhanced smart speakers, e-book readers and TV accessories, all powered by AI and integrated with Alexa Plus. Amazon's Senior Vice President of Devices and Services, Panos Panay, spoke to Bloomberg about the latest offerings.
The new Alexa Plus, is powered by AI, so it's LLM backed, if you will. So limitless knowledge, limitless understanding, and you can have any conversation. It's quite conversational. So when you talk about what you're typing into a phone, one of the things I like talking about is maybe even a little easier now, Ed, because you have all that kind of infra, you literally can just speak. I call it we as a team call it ambient AI, and we believe that your Echo devices right now, as you light them up with Alexa Plus, just have any conversation at any time. I think there's something quite powerful about that too, where a lot of times we take out our phone, we get distracted. I'm at the dinner table with my kids. We have this idea that we want to keep our phones down, right? Because we want to be present with each other. And there's so many times where you pull out your phone to answer a question, almost like you just said. But now it's just changed. It's completely different. Just say Alexa, have the conversation. It's quite literally all the information there, and it's conversational. Not only that, she can then get the next thing done for you. Let's say you have a conversation, you want to talk a little bit more about what's happening and what do we think about what's happening tomorrow. You just add it to your calendar right there and then, just with your voice. It's distraction free, it's ambient, and it's so fun because you're just engaged in a totally different way with your voice, just as you said.
Alexa Plus is listening more contextually. It is listening more intelligently.
Yeah.
How do you build trust with the customer and consumer base, knowing its capabilities?
We've been doing it for 10 plus years. This is what we are 100% focused on for our customers. At the end of the day, the way you do that is you give your customers full control. Opt in, opt out, remember what you want, just literally control your data for yourself. Plus everything to Amazon is anonymized, so we don't really have any info. So at the end of the day, it's up to you and what you do with your product. And I think that's what the answer is. You give customer full control, and we do. We're very proud of that. Like, that's a big deal for us.
Panos, is there like a generational divide in the Alexa user base? And how does this generation of hardware change that? In other words, is there just a group of people in society that are going to come to AI-enabled devices for the first time here? And if so, for what reason?
We do think so. We do think so. Well, a couple of reasons. One, these are objects, and they're beautiful. This matters. Like when you buy something, it's something you covet, something you wanted, and you go after. Because it's so useful and it can get so much done for you, and it has that depth of knowledge. We do think there's a whole new customer base coming in for Alexa to go use Alexa Plus. That's why these products were designed. And maybe to your first question, like thought all the way through, including how it fits in your home or how it fits in your apartment, where it just seamlessly fits in. And then with the beautiful sound that comes off of it, that elegance of just contextual understanding, combine those things and you end up with a whole new category of device for people, which then leads you to a whole new customer set. I'm pretty pumped about it.
That is Amazon Senior Vice President of Devices and Services, Panos Panay. He was speaking there with Bloomberg's Ed Ludlow. All right, let's take a look at how things are shaping up towards the open in Taiwan. And I deliberately didn't mention China. Markets there going to be closed today for a holiday. No trading either in Hong Kong today. But we see Taiwan futures currently higher by about 0.5%. We have trade talks with Taiwan and the US apparently now entering crucial closing stages. This is according to the Taiwanese premier as well. The delegation describing meetings as positive also. Take a look at S&P futures. Meanwhile, they're off by about 1/3% because we do have a situation where the US government is heading towards a shutdown. That just over 3 hours away now if a last-minute agreement can't be reached, and that does seem highly unlikely at this stage. We did see US stocks ticking up a little bit higher in the regular session, but futures currently pointed lower by about 1/3%. Avril.
Yeah, Paul, I'm here at the Milken Asia Summit. Stay tuned for plenty of great conversations slated throughout the morning at this event in Singapore. We'll hear from Macquarie Group and govt Capital. Keep it here with us. This is Bloomberg.